Well, how many times do I have to say this? The real estate cycle is ending. And if you're under 40 years old, you have no idea what is coming. You have not got a clue. Last time this happens, if you're 40 years old, you were probably still in college, finishing your junior or senior year, or just getting started in some kind of a job, probably not even entered into your career. And now you're in middle management. Now you got responsibilities. Now you have families, you got bills, you got mortgage payments, and you have responsibilities. And maybe you're in middle management, maybe you own your own company, but you've never seen this before. And it's coming. It's coming at you, and it's coming at you right as scheduled, exactly as we've talked about. It's the cycle is ending, and of course, it's not just the real estate cycle. The bond market cycle, the interest rate cycle is already ended. We still have the stock market to come to terms, and the real estate market is already. Now, again, remember, real estate is regional, so not every part of the country is going to react completely the same. I personally think that Florida and Texas are fabulous marketplaces long term, but they're way ahead of themselves right now, and I think they're going to suffer. And of course, when building slows down and you've got 200,000 or 300,000 workers that all of a sudden get thrown out of work, it's certainly going to affect the local economies, and I think that's what you have to look forward to. So that's coming. And not only that, but once you start getting these properties that aren't selling, we have so much on loans that are going to be defaulted. It takes a lot of the capital out of the marketplace. Underwriting is going to get much more difficult, and there's no liquidity is going to be around. So we have some tough sledding. So let's talk about the signs that are coming. Let me go to my first slide here, and let's just talk about the signs. Now, got this just the other day from Zero Hedge, Philadelphia Federal Reserve, again, for like the 12th out of the 15th month, they're saying that the business is collapsing in Philadelphia and in the whole district. And of course, this is a pretty strong district, but the signs are there that it's slowing down. No matter what happens, it's slowing down. And I don't think you can stop this. It's getting to the point the business is slowing so quickly, it's getting recessionary. Let me go to my next one. We got this from the Jolts just this morning. So what we're seeing is that there's fewer and fewer job openings, and they're actually cratering, and no one is leaving their jobs. So the quits are also in free fall because no one wants to leave their job. Now, what does that tell us? It tells us that the workers are starting to be concerned about making sure that they have an income for themselves. Great idea on their part. But it's telling us that the economy is slowing, that there's not a lot of jobs in the marketplace. So if you leave your job, you might not get another one. Now, I also got this morning. This is so disappointing. Here's Conn's, 134-year-old American furniture chain, 134 years. It filed for bankruptcy, and it's shuttering all of its stores, over 500 stores. Just think of all the vendors that are involved with that. Just think of all the employees that they have. Think of all the financing that went on with that. Just think of the big hole that this is going to cause in this economy when they see this. And of course, the economy changed. We talked about the fact that the cycle peaked in second quarter of 2022, and it's been slowing down. These things don't happen overnight. They are a process. We've talked about the fact that they're a process. We've talked about that. Things like this happen. And you need to be able to recognize them if you're going to survive them and prosper, because those people that don't realize what they're looking at, and there's going to be a lot of them, are going to make lots of mistakes, and they're not going to be able to reap the benefit of what's coming, because there's going to be tremendous opportunity. So there's going to be a lot of loss, but a lot of gain, and we want to be on that gain end. So let me go to my next slide. Just talk about that. Now, as I mentioned before, the stock market has not cracked. It's just done incredibly well. It is so narrow. We're talking about a marketplace that's really down to 8 or 9 stocks, and of course AI is the big term. So if those guys crater, that everything else is going to come down with it. So this is coming from John Hussman. Let me open this up a little bit. John Hussman is a mathematician, a PhD. He is head of the Hussman Funds, a brilliant guy. He sent this out in his newsletter. I'm using his guide here, and I want to tell you that according to John, now he uses the GVA, which is a gross value, but according to him, today's market is more overvalued than it was in 1929. And you remember how 1929? So we have extremes in the stock market. We've got certainly got extremes in the real estate market, and we had extremes in the bond market. And the bond market, of course, was ahead of us. It topped in 2020, and that people have taken losses of 20, 30, and 40% in the bond markets. It's destabilized a lot of the banks. So this is something we need to be very, very concerned about. So let me go to my next slide, and let's just talk about that. Again, I got this 2-3 days ago. Dr. Copper is also telling us that things are slowing down. Now, there's a big jump because they thought things were going to get better, but obviously it's correcting. And as copper goes down, copper, of course, everyone knows is used in virtually everything manufactured across the globe. It's a really, really good indicator of what's going on. So when Dr. Copper starts dropping in value, you have to understand that the demand for that is dropping. And once we start recognizing that demand is slowing, and what kind of demand is it? It's manufacturing demand, and that also is slowing. It's a really, really good sign. It just tells us that this is what's coming. Let me go to my next slide. Now, right in my industry, we've been talking about the fact that new home sales are literally collapsing. You can see this in this chart, is that in 2021 and 2022, it was just wonderful. All you had to do is put a sign out front, and you're going to sell a property. And the builders were just, if one house was good, they're built 10. And, if 10 were good, they're going to build 100 and 100 and 1,000. So they were building new homes and selling them. And, of course, prices kept going up. We had lumber go up. We had copper go up. We had, concrete went up. We had shortages of glass and dishwashers and air conditioners because there was such a huge demand, and prices kept escalating. And, of course, then in 20 and 21, the builders see all these things are doing so terribly well. Let's go buy some more land. So instead of just buying, 100 lots, let's buy 1,000 lots. And how are those lots financed? They are put on short-term notes because, they're going to be taking them, rolling them out. But in the meantime, they've got to go through the cities, they have to do their due diligence with their environmentals. They've got to plat the streets and the sewers and the water and all the utilities. And they got to build some models, and it's going to take 2 or 3 years. Well, if that was 21, this is 24, and it's no longer such a good deal. This is what we see in apartments as well. It was a good deal 3 years ago, but it takes so long to build them and get them going that, the time has run out for them. And, of course, you can see that virtually everywhere. Now, I remember in 2007, I think that there were about 1.65 million new homes available in the United States. I think we're already about 1.75, 1.8, probably going to go close to 2 million homes because the builders want to build out their land. They have to build the land out. So the only way they can get out of their land bank is to build it out. And as long as the lender is going to give them money, they will build. They'll continue to build. But eventually they're going to get cut off. And when that happens, they'll go out of business and the banks will start selling. And, of course, the builders today, they want to sell everything. They'll make any kind of deal they can to get rid of them because they need to sell these properties out. Let me go to my next slide, and let's just talk about what's going on. Now, again, I got this just a week or so ago, and we're looking at last month, 11.3% revision in May, and we're looking at 14.9% now. Down. So year over year, we're down 7.4% in sales, and they're building like crazy. So building a lot, not selling much, bad combination for our builder friends. It's just not good. Let me go to my next slide. This is what's happening in Phoenix. In Phoenix, multifamily vacancy expanded 9.2%. Our vacancy is like 1 and 2%. And so the startup, the new builds. Now you have to understand the new builds are all A properties. So the land was very expensive, and of course, as they were building, the prices kept escalating. glass again. You couldn't get glass, you couldn't get air conditioners, you couldn't get dishwashers, you couldn't get flooring. You had all kinds of problems with concrete, and this just kept adding to the cost of the buildings. And now these buildings that you were originally going to lease for like $2,000, now they're trying to lease them for $28, $29, $3,000, and they're having a resistance on affordability. Same thing as in housing. So here in Phoenix, as good as our market is, we still have affordability issues, not demand, affordability. People can't afford this. And of course, we're at 9.2%, and we're expanding the startups to 4 and 5 and 6 and 7 months. So you finish your project and you can't fill it up. That's a real problem for them. Now, you have to remember now, my marketplace is completely different. We're in a single family affordable homes. Our vacancy factor is like 1 or 2%. So, same asset class, 2 different markets, and these guys are in problem. This is affordability issue. So we are very, very affordable in our space, but affordability is the issue. Let me go to my next slide and let's just talk about that. So I've been pounding the table on this. We've been coming up. We're up here. Again, when I talk to Dr. Nenner never cares about why this is happening. He just says, I know what is going to happen. And of course, we're talking about the cycle. We are up here. Now, I've got a point here, but it's not a point. It is a process, and it'll take a couple of years. And that process started in June of 2022 here in Phoenix, Arizona. That's when it happened for us. We could see a peak. It coincided with the peaking of the liquidity cycle as well, and it's been down ever since. So here in Phoenix, we peaked. Our prices peaked in I think second quarter of 2022. We've not exceeded them. We're still bouncing along. Again, it is not a point. It is a process. But let me go back to this slide so you can see this. It was great fun coming up this left side. This is a boom area. So this is the accumulation phase, and this is the explosive phase. And this is the we don't want to buy here. We don't want to buy here at all. We don't want to buy over here either, because we're going to roll over, and it's going to come down here, and it's going to go into the bust phase. So it will mirror this. So in Phoenix, Arizona, we were looking at 3 and 4% appreciation per month. Well, we're going to have 3 and 4% depreciation and declines per month as well, just to catch up to what it was before. It's focused in the commercial space, so Phoenix probably won't be affected anywhere near as much as some of the others. I think again, you start talking Austin or Fort Myers, Texas, Dallas, and Houston. So all these places are going to be affected more than us because they got way ahead of themselves. Here in Phoenix, of course, our market's changed. We're more of a manufacturing a marketplace now. We have lots of chip manufacturers and startup companies. So we're moving to high tech and a lot of manufacturing. So our market changed a lot, but we're not going to be immune. We're certainly going to go down as well. So it's just going to be a very, very interesting time to take a look at this. Let me go open that up. Let me get a little more specific here, and let's look what's going on. Now, I got this from John Rubino. If you want a good interview, John Rubino was kind enough to speak with me a couple weeks ago, and it was one of the best interviews we ever did. And if you want to just look at what's coming and get some ideas as what you can do, that's the video for you, because housing is unaffordable. It's absolutely positively unaffordable. That's not a demand problem. It is an affordability problem. Now, the affordability now is worse over here, is worse than what it was in the great financial crisis. And you can see what happened here was that the affordability got very, very bad, and it came down to here. And then the market broke. The market broke. And this is the affordability going up because the prices were coming down. And here we go. We had very good affordability. That's when everybody can afford. You can more, double the population could afford a house in Phoenix. It was just a great affordability time to buy something. And again, here we come down in 2022, and now we're worse than we were in the great financial crisis. So the affordability has become a major, major problem. So if it's become a major, major problem, I'm telling you, unless you went through this, you don't understand what's coming. Because if affordability is the problem, affordability is the solution. Let me go to my next slide and let's just talk about that. You're going to want to see this. Because what has history taught us? How has affordability or unaffordability been resolved in the past? What has happened in the past? Well, that's the cool thing about being older, is I can remember these things. I remember exactly. So how did it get resolved during the great financial crisis? Because affordability came down to terrible, just like now. Matter of fact, now it's even worse than it was in the great financial crisis. How did that get resolved? How did that happen? Let me go to my next slide and let's just take a look at that. Because here it is. This is coming out of the Federal Reserve electronic data system. You can see here we peaked. This was actually peak number 2. It was actually higher than peak number 1. And it may happen this time again, but in Q1 of 2007, the median home price across the United States peaked at $257,400. That was peak number 2. And it came down and took about 2 years to get here, lost 19% across the country. Now, in Phoenix, it was way worse than that. You know, some of my properties dropped 60, 70%. I didn't care because they're all free and clear. I was just getting my rent never changed. But the value of them dropped like a rock. You know, but on average across the country, we were down to 19, we lost 19%. So in Q1 of 2007 to Q1 of 2009, it went from 257 to 208 for almost a 20% loss. And that took 2 years to do that. And of course, you know, it depends on what index you're using. This bounced along for a very, very long time. It bounced along for a couple of years. And actually, I think it actually kept bouncing until like 2012. But according to this, when it just bounced, you can see it went up and down, went up and down. But you could have bought anywhere through here and you'd have been just fine. But it took 2 years and then another 2 years, and then the recovery started. You know, Q4 2011, Q1 of 2012, about the same time. But it was still loss of 14% after 4 years. So that is really what you're looking at. And I'm going to assume it's going to take I'm assuming it's going to take about 4 years for this to resolve itself. And I'm expecting it has been exactly as we said. We thought the recession started in Q3 of 2023. I thought the real estate housing market would be good the first quarter and second quarter of 2024. And I thought we would start seeing declines. I think you're going to start seeing that. It's already very, very evident in commercial and multifamily now, and that's due to the interest rate lag. And, you know, if you didn't have to refinance for the last couple of years, you just enjoyed a nice cash flow. Moment you have to refinance, moment you have to put financing in anything, it becomes no longer viable. And we're expecting huge amounts of defaults. Let me go to my next slide and let's just talk about that. So this is what happened in 2005. We got up to 5.25%. And right here, in July of 2007, let me go up to this one. This is right at Q1 of 2007. So right in the same time frame, the Federal Reserve decides they're going to start reducing rates, and they just reduced rates aggressively. So they went from about 5.25 down to just almost zero, almost like 0.25% in like 6 or 7 months. You know, it didn't take them long at all. But what happened to the marketplace? It kept falling. So once it starts, there's no stopping it. Once it starts, there's no stopping it. And that's what's going to happen. So if you've got property that you're thinking of selling, you need to do that now. You should have done that, 6 months ago. But don't wait. You know, if you've got stuff that you have to do, don't wait. And if you want to buy something, you want to wait. You know, so if you're a first-time home buyer, I would enjoy renting for a little bit, keep accumulating cash. I think there's no incentive. I don't see any prices going up. I don't see it skyrocketing. I don't see interest rates coming down. are going up in the future where it's imperative that you do this now. So there is no reason for you to rush out and buy something. But if you own, get rid of it. It's time to sell. Now, in my marketplace for investment, we have a huge demand, an unbelievable demand. Even in housing, it's going to be a unbelievable demand. So a new housing, it's just affordability. Now we're in the affordable home space. This is where this is our wheelhouse. So our portfolios are renting. The average in Phoenix is $2,200 a month for rent. Ours is running like 1,900 to 2,000, and we make great cash flow. So we're always leased. We're always up and running, and our people stay for a very, very long time. My average tenant is 5 years. I tell people 3, but it's really longer than that. It's closer to 5. So it's going to be a terrific time for you to buy. Not quite yet, but according to our charts, we're going to start looking at this in about 9 months. Let me go to my last slide here, and let's just talk about this, because this again comes from Charles U. Smith. I've used this before. It's very difficult to understand that you are in a bubble when you're in it. But once they pop, you can start recognizing it. Now, I'm going to tell you, we're probably somewhere around here. We've come down and we're popping. We're probably right around here on the cycles. I just bought a trophy property that just an unbelievable piece of property that had to be sold, and I was more than happy to buy it. I got a very good buy in it, but it's a trophy property. Not for everybody. This is not in our portfolio, but very, very good properties. That's what you see up here. And then we're going to start seeing more properties come to market. This will be new homes. You're going to see some really deals on new homes coming at this very first buy point. And then, of course, once the new homes are gone, they're gone because there won't be any more. Now, new homes are typically out at the outlying edges of the city. So sometimes they take a while to lease because they're so far out. But, our holds are, if you're holding 5 or 10 years, they're just absolutely terrific buys. And then we're going to have another couple buy points here. This is really probably the best. This is where you get, it's not the bottom, but it's awfully good because there's an awful lot of good properties here. And then, of course, then there's another buy point. So we've got 4 buy points that are coming at us. I think the first one is probably 9 months from now. So maybe first quarter 2025, maybe second quarter. Again, we'll know by the signposts. But we're looking forward to it. Again, I've talked about in other videos. By the way, if you like our videos, give me a thumbs up, subscribe. YouTube loves that. I'll tell you that I think we're going to have probably sometime in first quarter. But when we talk about allocating our funds, we only want to put our toes in the water. So maybe 20% of our capital we want to allocate for the first buy point. And we'll go 20, 20, 20, and 40. Probably. So we'll just see how the market goes. Let me go to my next slide, and then we'll wrap this up. And by the way, if you have any questions, I'd love to hear from you. Let me know your comments. Just love to hear what's going on. If you'd like to book an appointment with us, we're very, very inexpensive on consultations. We'll try and do some ideas as to what's going to work for you. We'd love you to get involved with us. If you're looking to join with us, we're not looking for capital, just commitment. So don't send me, $500,000. I don't want your money right now. Just tell me I've got $500,000 I'd like to commit. That'll be fine. And when the time's ready, we'll call you. Now, I'm going to tell you, when we call you, you're going to tell me we're crazy. There's no possible way I'm going to buy anything because it's just awful. And the economy will be scary as all get out. It will be awful. People are going to be losing their jobs. Companies will be closing. Bankruptcies will be everywhere. There'll be lots of family problems. People losing their cars and being evicted. It'll be a terrible time. Really a good time to buy. And that'd be my job. I'll tell you it's time to buy, and we'll make money together. So this is where you can reach me. If you'd like to consult with us, I'd love to. So my very, very best to you guys. Bye-bye now.